We shall now move into the next item in our agenda, Fireside Chat on Innovation Ecosystem. The session will be moderated by Brian Lim, Executive Director and Head of Dana Impact and Healthcare, Khazanah. He'll be joined by Christine Tsai, CEO and founding partner, 500 Global, and Jupe Tan, Managing Partner, Asia Pacific, Plug and Play.
Good afternoon, everyone. And maybe just give a few seconds for people to take their seats. So for those of you who were here yesterday, specifically the after lunch session, you might find me looking a bit familiar. Yeah, I drew the short straw again, and I will claim that free meal from Nick. Okay. Well, since we continue on the theme of food, we've talked a bit about it this morning, and I hope you all had a good lunch. And because today one of our guests here is from Singapore, I will refrain from repeating what Nick said. For those of you who are around in the morning. So I think for our overseas guests, as well as I think Malaysians in general, very frequently you get feedback from your overseas friends that Malaysian food is amazing, right? Malaysian food is one of the best in the world. Overrated or underrated? Underrated. That's the right answer. Excellent. Great. Yes. So I believe personally that Malaysian food is so great because of our multicultural background, right? It's all the different herbs, the different spices, the different cooking methods that once you put it all together, you know, we just come up with new, innovative, and amazing dishes. And this is actually quite related to our topic today, this afternoon, about innovative ecosystems. If we look up a dictionary, the typical definition of innovation is that, you know, it's a new product, it's a new idea, a new design. But when we sort of double-click into it and compare and contrast it with what's invention and what's innovation, well, invention is typically creation or discovery of something that is totally new. Right? On the other hand, innovation is more of the discovery or the invention of something new using existing ingredients. Right? So on this topic, and that's why I believe that actually Malaysia, Southeast Asia, we actually have all the ingredients to be a better and to be a more robust innovation hubs. So today, we have our two guests here, Christine Tsai and Jupe Tan. I think I will let them introduce themselves. So Christine, I'll pass to you first.
All right, thanks, Brian. Hi, everyone. I'm Christine Tsai. I'm a CEO and founding partner of 500 Global. I'm here from Silicon Valley. 500 is a global venture capital firm. We have about 2.8 billion in assets under management, portfolio, very broad, diversified portfolio across various geographies and sectors, Southeast Asia being one of our biggest hubs and regions. In the region, we have 300 investments in the portfolio. Specific for Malaysia, 60 of them are Malaysian companies and 120 are operating in Malaysia, although they may not necessarily have been Malaysian originally. We broadly operate in about 15 countries around the world. Our portfolio spans more than 80 countries. So certainly we are very much global, hence the new name, and we continue to lean into that. We've historically been early stage investors and we continue to be. We are also expanding broadly to multi-stage. So a lot of exciting things happening, but very glad to be here in KL.
Test. Thanks, Brian. Thanks, Christine. Very happy to be here. I promise I won't say anything controversial, and I will just start by saying that the char kway teow in KL is the best, even though I'm from Singapore, so we can start with that, right? My name is Jupe. I'm originally from Singapore, born and raised, went to school there, but I ended up in Silicon Valley. I spent about 15 years there before relocating back in 2020 because of COVID. Similar to 500, We are VCs as well, but we are at a much smaller scale. We invested starting as a family office in the late 90s, and Plug and Play was only officially established in 2006. I joined in 2008 when we had less than 20 people in the team. But today, we are in roughly about 40 plus cities. We have about 600 plus folks that are investing and doing other activities worldwide. We have about just under 2,000 startups that we've invested in our portfolio over time. We are way behind 500 in terms of investments in Southeast Asia and in particular Malaysia as well. In Southeast Asia, we have activities and investments in Singapore, Indonesia, Thailand, and the Philippines, and we plan to establish a footprint in Malaysia too to start investing and to do our corporate innovation activities. So we're very happy to be here. Hopefully I can contribute something useful to the discussion today.
Great. Thanks, Jupe. Thanks, Christine. So, Christine, if I may start with you, right? 500 was really founded in Silicon Valley. What was the evolution and how did you find your way over to Southeast Asia and to Malaysia?
So, we started 500 in 2010, and at the time, if you remember, where tech was and venture was is quite nascent, especially compared to where we are today. So back then, seed stage was a relatively new stage of venture, and for us, what we were really looking to do is one, to de-risk early stage venture. We felt that applying the traditional model to seed, and now there's a term pre-seed, was actually not the right fit. Just from the perspective of the founder, but also from how to actually deliver returns at that early stage. There's not much to work off of. There's not much to diligence. It's really a couple founders trying to get to product market fit. So for us, we were really looking at building a larger portfolio, tracking the companies, doubling down on what works, and we felt like this is actually how you bring in more of a systematic approach, a de-risked approach to early stage venture. I know there's a lot in the audience that may have question marks about venture capital being a very risky asset class, high risk profile, but we saw a lot of opportunity in terms of you can generate significant upside and alpha at the early stage. So that was one. But again, now it's kind of a common way to do early stage venture, but back in 2010, very new. And then secondly was the global approach. So venture was very much Silicon Valley. Investing outside of the valley, let alone outside of the US, was seen as quite contrarian. But we wanted to look at what does the next 5-10 years look like, and that the next big companies would also come from outside of the US. So we started investing internationally. Actually, our first investment into a Southeast Asia company was in 2011, and it subsequently was actually our first big international exit. So Viki, which was acquired by Rakuten for about $200 million. And in about 2013 or so, we started to really invest into Southeast Asia, starting with our first Southeast Asia fund, which is now today our Southeast Asia efforts are led by my partners Kylie Ang, who's based here in KL, and Vishal Harnal, who's based in Singapore. So we have really seen a lot of the potential in Southeast Asia way before Silicon Valley has. Now the way the world looks with tech, 1,000 unicorns, more than half of them are outside of the US. In our own portfolio of Southeast Asia, we have 7 unicorns, and we definitely see that growing. So we are definitely long on Southeast Asia, certainly in Malaysia. We actually, 20% of our global team is based in KL. So we've certainly seen the opportunity from a talent perspective as well as the portfolio perspective. We only see that growing.
So somewhat similar journey to 500 with some slight tweaks. Pre-2010, Plug and Play was primarily investing in the US and 80%, I would say, Silicon Valley. So our CEO at the time asked me in 2010, we should start investing internationally. And I said, of course we should. And then he asked, where should we go? And I said, let's go to Singapore. And perhaps 500 started here with Kylie because Kylie is here in KL. So at that time, I think it was still pretty early, right? 2010 or so, we were starting to see the first, second waves of good startups rising in Southeast Asia. If you say that perhaps Southeast Asia is a few years behind China, a few years behind Europe, a few years behind Silicon Valley in that sense, I think we all saw the opportunity. So we came and we started investing. 2010 to 2015 or so, we only did a few investments. I think partly because there was too much capital in the ecosystem, and it takes time to grow the startups. It takes time for good startups to appear and grow. So we were not so active in the earlier years, but after 2015, after 2016, by then we had evolved our business model to what we are today, which has three parts. We run accelerator and other innovation programs. We work with Fortune 1000 MNCs on corporate innovation and other related activities. And then we do early stage investments. Our check size is relatively small, between 100 to 150K. So it took us some time to see the better opportunities out here.
Excellent, thank you. Yeah. Right, so I think for the benefit of the audience, as Khazanah looked at how we plan to deploy our capital under Dana Impact, which you may know that it's our new initiative to invest to really improve the resilience of Malaysia and also increase our economic competitiveness. We really believe that the startup ecosystem in Malaysia is a very critical one. It's a birthplace of innovation, right? Of new ideas. As an extension of that, new businesses, entrepreneurship, job creation, and ultimately economic growth. So on this note, we are actually looking to invest and in this space and to find partners in this space as well. If I link a little bit back to my session yesterday, a lot of these social companies or startup companies who are looking to start new businesses with a social lens, with an environmental lens, a lot of them are actually scrappy startups, right? They're the ones that was mentioned yesterday. And I think we want to look at how we can support and assure you guys better. So on this note, I think the high-level megatrends that Dana Impact has identified that are important. These are no surprises to everyone in the room. Stuff like digitalization, how is it impacting companies as well as consumer and day-to-day life. Stuff like food security, like climate resilience, healthcare and education. Which of these trends, do you all see from your portfolio companies globally are really critical ones, and what are the, maybe if you could share some of the trends that you see, the micro trends that you see within these themes?
Yeah, okay, I can start. So thanks, Brian. Well, we've looked at the 6 areas that Dana Impact looks at, and what we did was we cross-referenced that with the 18 to 20 or so verticals or themes that we invest in or that we work across, and we've identified perhaps 3 to 4 overlaps, which is what Brian just said. So perhaps starting with digitization and digitalization. And that impacts across industries, right? Using, let's say, financial services as an example. Every region, in some cases, every country has different challenges and opportunities. In the region, it might be more financial inclusion, access to loans and microloans, digital lending, etc. So that's one big area we think has a lot of impact and has a lot of room for growth. The second one would be food and agri-tech. I would say there's been a lot of food discussions in the past 2 days, and we also want to add to that. I think the pandemic has brought food security to the forefront, right? So just looking at some of the numbers out there that continues to blow my mind. I believe something like almost half of the food supply or food generated in the world is wasted. If we use US as an example, I think 30 to 40% of the food supply in the US is wasted on an annual basis. And that comes up to something like $500 billion that is lost. And I almost think that's criminal, right? There are so many hungry people in and around the world. So that's one thing that I think a lot of innovation should take place, whether it's better repurposing of food, reducing waste, etc. And then perhaps coming to the broad area of sustainability, climate and otherwise. If I pick one area, Plastics is something that we look at quite closely. I think perhaps I would say many of you would probably know that Indonesia is the second largest generator of plastic waste after China. And so eliminating that in our lifetime, I don't know if it's possible, but at least the reduction of use of single-use plastics and all that is something that's, I think, is ripe for innovation, has been. I think recycling as a process or technology hasn't worked well globally forever. So there's a lot that can be done there as well.
I think for, as we look at companies that have been funded and then what are the new opportunities now, we actually see that this is pretty relatively consistent across all of the regions that we invest in or we look at, even in the US, where there's a very big need and opportunity for a lot of these areas like sustainability, digitization, increasing that type of access for the 99%. So there's been certainly a lot of critique with some of the bigger tech companies that really cater towards that 1%, people who can afford to pay for their services. But there is certainly a lot of attention and demand around things like financial inclusion, not just the investment, robo-advisory that really just caters to people who already understand investing, but really what about the rest of the consumer base that maybe is not banked or doesn't have access to those types of tools, what's really unique for those markets. In addition, I think one of the areas that falls into that is when we talk about digitization, we can call it different things like rural digitization. We have a term in our team that we call all commerce versus e-commerce. So generally enabling technological innovations for that offline commerce is certainly quite big, as well as sustainable cities. Because when we look at a lot of the activity and growth happening in cities, there's always a lot of attention on the major cities, but there's also the next rising cities, and majority of the population for many of these countries around the world, that's where they live. And U.S. as well. There's a lot of San Francisco, New York, et cetera, but there's a lot of the rest of the U.S. that doesn't necessarily have that education or awareness on these technologies. And then I think a couple more things to add that certainly fall into this theme of increasing access or leveling the playing field is around healthcare and education. I think especially in the last couple of years with the pandemic, it's ever more apparent that there is a huge gap in access to quality healthcare or even access to healthcare at all, as well as education. Technology can have a huge impact on that, particularly as you look at certain demographics that are fast growing but very underserved. Women is one, certainly women's healthcare is certainly one. And in terms of education, we see very big gaps that technology can help with, and ultimately these all will create a much more sustainable ecosystem in these markets.
That's great. Yeah, I think even when I looked at 500 and how you define your mission, which is to uplift people and economies around the world through entrepreneurship, even though you don't market yourself as an impact fund, but I do actually feel that inherently it's already embedded in the DNA.
Yeah, and that's actually one other good point that despite it being labeled as like impact or whatnot, I think venture is actually one of the most impactful ways to do that, because a lot of the people that are creating these big game-changing companies or an innovation in these markets are founders. They may not necessarily have had the good fortune to be in an environment that can enable that. And in fact, many of them are building companies despite the cultural pushback or the lack of funding or lack of resources. But it's oftentimes those are the companies that are going to be the biggest outcomes or biggest impact.
Great. So I think when I look back at our topic today, which is innovation ecosystem, I'd like to bring in another piece of the ecosystem, which is corporates. Right? So Jupe, maybe from your side, I think Plug and Play works a lot with corporates specifically. In fact, it is almost like your differentiation point from other firms. Could you share a little bit more about how and why you think corporates should be more involved in this place, and what are the things that they should think about?
Sure. And perhaps I can use the example of how We started off by investing into individual startups. And then just like a lot of investors like us, we started running incubation and accelerator programs. And these started with, let's say, very early stage accelerator programs, incubation programs where we are writing checks of US 25,000 to 50,000, for example, batch-based, etc. Y Combinator perfected the model, and they're still doing really well at it. Where we saw that fundraising, getting money to the startups, getting the next rounds of investments is extremely important. But in most cases, beyond the investments, they would prefer to get their first customers or their second customers or their next set of customers. So that's where we think the corporates come in, and that's where we evolve many of our accelerator programs over time. Today, we're running about 70 to 80 programs at any one time around the world. And we almost call them like an accelerator 3.0, 4.0, where it's almost a business development program. If we pick an area like financial services, we would want banks, insurance companies, FIs to sponsor the program, not just to provide, let's say, mentorship and funding, but to provide problem statements and interest areas. And I think that's where we've seen the importance and success. If we just talk about large corporations in general, they have a lot of innovation takes place, a lot of R&D takes place, but at the same time, you are going to, let's say you are a really hardworking corporate worker. I think most of us are here. You show up at 8 a.m. and then you leave at 8 p.m. You have your day job, right? You have your main P&L responsibilities and all that. And where do you find time to, innovate or think of ideas? So we think, to a large extent, that's where startups come in. The plugging into external innovation. Sometimes we even use the phrase corporate innovation through startup acceleration. So I think that's very relevant today.
Great. Would you be able to share some examples of corporates and how participation in your programs have actually come up, birthed new ideas and new products?
Sure.
Yeah.
I mean, some specific examples are a little bit harder to say, but if I use this very broad example, about 5-6 years ago, Daimler, Mercedes-Benz, they are one of our biggest partners. 5-6 years ago, we were working with them in Silicon Valley, and they said, can you guys come to Stuttgart to set up a program with us? And we said, what's in Stuttgart? And they're like, Daimler is in Stuttgart. And we're like, okay, who else? Why should we go? Anyway, we went and we started the initial collaboration between Daimler, Plug and Play, and the University of Stuttgart. And when we started, it was just 3 partners trying to attract startups into Stuttgart to work with the ecosystem. Fast forward to today, Startup Autobahn, which is one of our flagship programs for mobility, has about 35 or so corporate partners, and they are up and down the value chain, from OEMs to distributors to competitors of Daimler. And in the earlier days, we were investing in some of the startups, encouraging POCs and commercializations, and we're happy to say that today, at least perhaps on an annual basis, there are 80 to 100 POCs that are being conducted through the program. I think we're reaching the 10th batch of that program. And there are now technologies that are in the cars, in Daimler's, in Mercedes S-classes and E-classes. And and I don't know it that well, but this was what was told to me. If you look at the automotive industry, to get a new technology into a car in less than 5 years is next to impossible. So I think that demonstrates the value of the corporate startup interaction.
Christian, would you have anything to add to this?
I think definitely corporates play a very important role in building the overall startup venture ecosystem. I mean, certainly we've seen this in Silicon Valley. We have the benefit of like 50, 60 years of this, but they play an important role in terms of being acquirers for M&A activity, sometimes investors, certainly partners and distribution platforms for founders. And I think that many of them are struggling to keep up. They're being displaced by these, more agile startups who now become, maybe they also eventually graduate to becoming big corporates, but there's a lot of these legacy industries that, some of them can adapt. They all feel the need to, but the DNA of the company doesn't necessarily operate that way. So I know, like Plug and Play, they certainly work with corporates to help them build that capacity. For one of the challenges I think we've seen with corporates in our interactions, both as like partners or acquiring companies, is that there's a very big disconnect between how they operate and how the founders or the early stage companies operate, whether it's the terms of whatever partnership or deal, or just the desire to innovate technology, but then they also need to understand that investment takes time. So a lot of accelerators or corporate innovation initiatives often get shuttered after 2-3 years because there's the executives or the board does not see the ROI. So it's unfortunate. Even for 500, venture is a long game, especially early stage. It's not an in or out asset class. It takes fund is at least 10 years, if not 15 years, to see these early stage companies grow from just the founders all the way to IPO. So I think that patience is not something many corporates have or can afford to wait for. But again, I think that there's depending on the company, depending on the urgency and how it's implemented is quite critical.
I mean, just to add very briefly, when you're looking at your stock prices, your market cap, your quarterly performance, your annual performance, that's where it becomes really challenging to have that long view, if you will.
Okay, great. Coming to something that you mentioned earlier, Christine, about VC investing being inherently a risky business, right? Because we are investing in really early stage companies with probably yet to be proven business ideas and products. How would you advise or share your views around how do you mitigate these risks, and as potential investors, how do we think about these risks?
I think the question of risk, I think it depends on who's asking, of course, and who's receiving. So if you're talking about as an investor, how do you mitigate risk? Because that's a question oftentimes LPs will ask us. A lot of that is really baked into the model. So what I spoke about earlier, how 500 got started and how we designed our investment thesis was again to de-risk early stage venture by building a large portfolio and diversifying that portfolio. Traditional venture is you don't have that many swings. It's 10 companies, really concentrating those investments, and you need those big outliers for the fund to return, not just the principal, but ideally 5-10x, something very significant given the early stage. That's very hard to do at the early stage, and I'm talking early stage, not Series A and B, although it's hard there as well, but at seed stage. So for us, and now we can actually share that our track record shows this model does work, because majority of our funds at the global level and at the regional level, even as we move from seed stage to later stage, that diversified portfolio is a huge asset. It is why a number of our earlier funds are top decile, top quartile. We show that model does work. So from our perspective, that's how you de-risk venture. And I think also knowing that it is a long game, there's certainly a number of venture firms, very established venture firms that have good vintages and then some bad vintages, and it kind of evens out at the end. There are very few firms that can really have vintages perform consistently at 5x or no lower than 5x or whatever multiple you're looking for. Now, in terms of for allocators who are in alternatives and in private equity and subsequently venture, there's a number of those in many parts of the world that have varying stages. Maybe they're in venture, maybe they're overweighted to venture, especially what's going on in the markets right now, or they're still new to venture and are looking to get that type of exposure. I think in terms of how to mitigate that risk, I think certainly. I've heard really the strategies vary depending on the allocator, and that's why the venture exposure is usually typically very small in the beginning. But I do think that if you invest at the early stage in managers who have track records, of course, have that something unique that founders are looking for? I think that's a very common question. If you're backing a fund or a manager, ultimately, venture is one of the few asset classes, maybe the only, where the founders pick the investor. So that founder relationship is very, very critical. So as you're looking and evaluating firms to back, you want to know, with these founders, who do they want on their cap table? Like, why do they want this manager on the cap table? That's actually quite critical. And from that perspective, if you're looking at those firms and also diversifying yourselves in your own manager VC portfolio, early stage, late stage, I think it is quite prudent to have that mix, especially because growth stage right now is a little bit of a bloodbath, despite it being theoretically less risky. We've seen a lot of allocators actually start to flock a little bit towards late stage because, again, it's such a long term. The valuations have been slightly affected, but it's not to the extent that we've seen at the later stage, where they typically track public markets, and despite even companies in our portfolio doing very well, they're taking a bit of a haircut on valuation just simply because that's just what the market is. So, long story short, I do think that despite the perception of venture being risky, there's also significant reward. I think it is very, especially given where we think that it's still scratching the surface of just all the capital that's out there, like what's allocated to private markets versus public markets, and then you trickle that down into private equity, to venture. It's so small. Like we think this is going to grow even bigger.
Okay. Yeah.
I guess
Yeah.
I can add on a little bit to that. I think as an asset class for private equity, you definitely need venture capital, but like Christine said, is how much you allocate, how much risk do you want to bear, right? For the later and growth stage investments, and a lot of you in the room are doing that. But when you need to, when the startup needs a $50, $100 million check, unfortunately, a lot of people can write that check. And you will remember for sure the wins and the losses, and and if there's a return, it will, the multiple is not as high. We focus really on early stage, and perhaps I'll give an analogy that I use quite often, right? Again, like we've all been saying, it's a portfolio business. I think most of us are old enough in the room to remember buying CDs, compact discs, right? Let's say one of my favorite
Sorry, what
bands.
CDs again?
compact disc, CD,
What
right?
about cassette tapes?
Cassette, well, yeah, you have those mixtapes too, but let's use CDs, right? Okay, we don't want to say we're too old. So, one of my favorite bands, U2, right? They've had maybe 20 albums over time, and I must have at least 10 of them, right? And you could consider them as different funds, if you will. You buy an album, you really, really like one song, and then you like another 3 or 4 songs, and you will never, ever remember the other 8 songs, okay? So that's the risk of very early stage investing, right? You bought the CD for, $20, and it's worth it, right? But you have to remember when you compare that to a fund or a portfolio, it means that those 7, 8 real companies, real people, real entrepreneurs will not make it. And when you invest as early as we do, some of these companies, they don't exist after 18, 24 months, right? So it's tough, right? So I think the advice at the end of the day is be brave, right? Be brave and go forth.
Great. So I'd just like to remind everyone to prepare your questions. Come to Q&A after one more question from me, which is, I think, we, as potential investors, one of the questions we will have on our mind is that alignment of interests. So if we're going to outsource these investments to you, we're going to pay you some fees, how do we think about alignment of interest and making sure that what you're doing, as plug and play or 500, how would you conduct your business in such a way that it will also be in best of my interest? Yeah.
So in terms of alignment of interest, I know what commonly comes up is the the fees and the carry. So like I mentioned for venture, at least in terms of the carry aspect of the 2 and 20, certainly there is alignment of interest with the GP LP because the GPs certainly want to maximize returns, which is good for the LPs. So in terms of investment decisions that are made, I know I can really only speak for 500, but we definitely look at how do we maximize the outcome for the fund. And because we are investing so early and it takes 10, 15 years or 10 years hopefully, but it takes a longer time to see, to know if you're performing, we can look towards valuations, next rounds, funding raised. And now again, we have the benefit of seeing that full life cycle of a fund with our earlier funds and seeing that these work and that our subsequent funds are tracking quite similarly. So I think that from that aspect, in my mind, as having been in venture for more than 12 years now, that is aligned. Where there maybe is, what I kind of reading between the lines around the fees. I think that there is maybe this perception, especially at the later stages where they're amassing very large funds, that managers want to get rich off of fees and they're not working that hard to maximize returns. Again, I can really only speak from the 500 perspective. We definitely, that is certainly not the case because venture, especially at the early stage, there is a lot of heavy lifting from us as the team to provide help. Venture capital, oftentimes there is a little bit of a mismatch between how useful VCs think they are and how useful founders perceive their investors to be. There's a big gap. So you can guess who thinks what. But at least for us, like generally though with early stage venture, that is where investors can have a lot of hopefully positive impact in terms of helping them with resources, helping them how to do fundraising, connecting them with the right corporates maybe, helping them understand how to run a sales process. There's a lot more that's involved. And what does that take? That takes resources, that takes a team. So oftentimes the capacity that venture capital firms build out with that type of budget is portfolio services or maybe a recruiting partner to help companies hire talent or whatever the firm wants to really specialize in. So that's where the fees go. I think it's especially at the early stage, it's a bit of a misconception that it's just going to the managers, and typically the fees the fund sizes are not that big. So as venture firms maybe grow and raise larger funds, it's certainly a different stage of investing. But I would say that it's not an uncommon notion that there are fees with different types of assets and different investments. I think for venture, especially at the early stage, that is not the end goal. For us, our end goal is that the fund returns significantly, because that's good for the LPs. It's good for the GPs.
I guess just to add on a little bit, we do invest out of some funds, but not many. So when we do that, the challenges and the alignment of interests are similar to what Christine said. Most of our investments are direct investments, and we do very often syndicate investments together with other family offices, other funds, individuals as well. I think in those cases, it's fairly straightforward. If you're interested in the startup, you are looking at the same risk, you're looking at the same due diligence, and you take that risk and expected reward, hopefully. Perhaps to add on the corporate angle would be that these days, most of our programs around the world or innovation platforms work with corporate partners. And I think the alignment of interest there is a bit more interesting in the sense that we sometimes have corporates that want to invest with us through their CVC arm, for example, and we welcome that. And that's similar to what I just said. We are going into the investment together. But in many cases, we are, again, coming back to what are the use cases or problem statements that specific corporates are looking at, and how can all of our startups, not just those that we invest in, but those that go through our programs, how can they solve specific business use cases? So I think that's where the alignment comes in for us.
Great, thank you. Okay, at this stage, I'd like to open to the floor. Any questions? Everybody knows what are cassette tapes and CDs.
We didn't say anything as controversial as the earlier speakers, so we're getting we'll have a safer questions maybe.
Hi, good afternoon. My name is Arvind from Zico. My question to both platforms is, globally, what sort of specific measures that you put in place when you filter out targets? And how fast do you come to that decision that this is the safe target that you would like to invest in? And how fast is the period? And what are the specific measures that you think would set yourself aside to say that this is our way of doing it? And that's my first question. My second question is, in dealing with lawyers, what are the specific challenges that you go through? And how best you think they could assist VCs? This is for both our benefits. Thank you.
I couldn't quite hear the first one because it was in and out. So you were talking about what are the risks of, I didn't quite hear. And when you say targets, you mean just investments?
Investment targets.
Oh, I see. Okay. So our criteria, we generally look at the early stage, and this changes as you go later stage because there's more to diligence. But the team is obviously the most important at the early stage. There's a lot of criteria specifically within the team, but just to keep it high level, we look at the team, we look at the market, we look at what is that serviceable. There's kind of this concept of TAM, total addressable market. We like to look at what's actually serviceable. Depending on what category, what industry or geography they're in, we try to get a sense of, do we have conviction that this could be a category leader in that market? And then, beyond that, there's some elements of how their distribution works, unit economics of the business model. We actually do care about, not that they have to be necessarily profitable or generating tons of revenue, because they aren't most of the time, but do they have a path to get there? And again, like depending on the sector, there might be specific items we look at, if it's fintech versus ed tech or e-commerce. E-commerce is an example where we have a pretty high bar. It's a much more mature industry. Frontier tech, if they have some sort of licensing, product is not launched, that's a milestone. But.
Well, very similar. We kind of use 3 T's, if you will: team, technology, and traction. At the stage that we're investing in, which is very early, financial projections and things like that are just that, projections, right? So you don't know how it's going to be. So we primarily look at the founding team, strong founding team with a strong business founder, strong technology founder, and then that comes 2 Harvard MBAs. I hope there are not many in the room. 2 Harvard MBAs that come and say, look, we've got this brilliant idea. It's a very slick deck. We'll outsource everything to country X. We'll come back when you have a technical co-founder, right? Then that leads into technology. There should be defensible and scalable IP, right? So that's, at least for software, that's what we really look at. And then traction is relative. So again, depending on the market, unit economics, etc. So that's a little bit harder to say.
And then the question about lawyers, are you a lawyer? Is that why you're asking?
Yes, I am.
With lawyers, I think because we have experience working with both in-house and our own counsel and the company counsel or fund counsel, I think one of the more challenging things is that when we work with counsel that's not familiar with venture, so it just may take a longer, just to keep it nice, like it may just take a longer to educate, but I think that when we do work with counsel in different markets, it's just something that we know we have to know what we're getting into, because that market generally does not have that kind of maybe competency yet, because venture is very new, especially early stage venture. So we just, but it's the story of our lives for 12 years.
And perhaps something that Silicon Valley has been contributing to the global ecosystem, if you will, is to try and simplify some of these documentation for investments and all that, from Y Combinator, from 500, even from us, etc. But I'll end that part with a joke, right? I've known my in-house counsel for 14 years now. And the thing he always says to me is, Jupe, leave the lawyering to me. So don't try to out-lawyer him, basically.
Thank you.
Perhaps we have time for one more question. No? Okay. Well, time's almost up. I probably end with one last request, which is to both Christine and Jupe. Could you make a bold statement, a bold prediction of what the VC space, VC ecosystem could bring in terms of value created, which we will definitely not hold you accountable to. Think out of the
Okay,
box.
maybe I'll take a crack at it. I was thinking about this question, and I think there's a lot more information that's out there. There's a lot more data that's out there. So access to market intelligence and all that. And with your initially when you were investing in equities, then you have index funds and ETFs and things like that. These days you have Robinhood. You can invest in the stock market from your phone, etc. Then you have crowdfunding and all those things. And I think it's a good and bad thing because I think the point I'm going to make is that VC as an asset class is going to be a lot more accessible to everyone, but I don't think everyone is aware of the inherent risks, the high potential rates of failure and the long view, etc. So I think that's going to happen. We've already seen it happening. That I saw a VC just last night. And I saw like a series of 8 emails, definitely sent by marketing, right? That said, we have all this data, invest in our fund, it's so easy, etc. And I'm like, and that's going to a lot of people, right? And I don't think that's necessarily a good thing.
Okay, a lot of pressure right now. All right. I do think that if we're talking about what is the big prediction or whatnot, I mean, I think for venture, I think one of the biggest things it can do, especially in markets that are more nascent, is it can normalize failure. So I think there's a lot that we've seen over the past 12 years where we have typically invested in founders in markets before there was any clarity on what's the downstream capital prospects, like what kind of exit is there for these companies. Southeast Asia first investment was into Vicky. There wasn't, there ultimately was an acquisition there, so there was an exit. But, we've invested in Mexico or Latin America, broader Southeast Asia, Middle East, Africa. Oftentimes, what we have found in consistencies in these markets, whether they're more mature markets or emerging, is that there is a lot of resistance to, there's a gap between wanting to jumpstart the economy, job creation, want to see entrepreneurship thrive, but then either culturally or whatnot, there's this resistance towards failure. And I think there's a lot of aversion to that, especially when you're looking at it from the allocator perspective, that you don't want to take too much risk, which is understandable. But I do think that failure is good. I mean, from a cultural perspective, that's how you get more entrepreneurship. That's how you get more people starting companies. Failure from the perspective of starting a company and failing, perspective from early stage investors, angel investors, knowing that, Jupe just talked about it, that the majority of your investments are not going to do anything for you. They're going to fail or just zero. So I think venture doing that, when we see these headlines about some venture-backed company shut down, especially there's a lot of that right now, I say actually embrace that as a positive, especially in markets that are not Silicon Valley, because that's what that ecosystem needs to grow. And again, remember, this is a long game. We've seen this over the years many times. We've seen negative headlines about companies in many, many markets, and there's always concern from the local ecosystem that it's going to be tainted, that global money, foreign money will not come into those markets. But I mean, I'm coming from this perspective of being in Silicon Valley, many, many failures all across the board, but the ecosystem continues to go. And I think, again, I think that's what these markets need. I'm sure within Southeast Asia, certainly within Malaysia, we're starting to see more of these. And I think that's just a sign of a more, the ecosystem's maturing. Ultimately, it's good. It's counterintuitive, but that's what's needed for this to be sustainable.
Excellent. Thank you for that. Embrace failure for future success. Great. Well, ladies and gentlemen, please join me in thanking our panelists, Christine and Jupe.